So, we all know Warren Buffett, right? The ultimate investing legend. We usually hear all about his obsession with intrinsic value, burying himself in balance sheets and crunching numbers all day. But what if I told you that a massive part of his secret sauce isn't actually about the math at all? What if his ultimate weapon relies on something you can't even put on a spreadsheet?
Welcome to this explainer. Today, we're unlocking what I like to call the masterclass playbook for finding truly phenomenal companies. We're diving into the brilliant mind of Philip Fisher. He's this absolute pioneer of qualitative growth investing and honestly one of the biggest inspirations behind Buffett's massive empire. If you want to learn how to spot world-class sustainable businesses by looking way beyond the numbers, you are definitely in the right place. Let's get into it.
All right, here's our game plan for today. We've got the Warren Buffett secret, the art of scuttlebutt, the 15-point stock playbook, why offense is the best defense, spotting red flags in management, and we'll wrap up with the power of patience.
Moving right into Section 1, the Warren Buffett secret.
Now, Buffett's always been super open about who influenced him. He famously said his investing style is an 85-15 split, 85% Benjamin Graham and 15% Philip Fisher. Benjamin Graham, as you probably know, was the godfather of value investing, finding companies so cheap you get this massive margin of safety. But Fisher? Fisher brought a totally different flavor. He's the one who convinced Buffett that, hey, it's actually way better to buy a wonderful company at a fair price than just a fair company at a wonderful price.
To really wrap our heads around this, let's use a horse racing analogy that Fisher himself actually used. Think of Ben Graham as the speed handicapper. This is the guy obsessed with the math, right? Past race times, track conditions, the exact weight the horse is carrying. It is all numbers. Philip Fisher, though, he's the class handicapper. He kind of ignores those raw numbers and looks at the bloodlines. He looks at the competition, the trainer, the jockey. Basically, he's looking at human factors and management quality. And Buffett's genius was synthesizing these two perfectly. Graham's strict quantitative discipline mashed up with Fisher's qualitative brilliance.
Okay, Section 2, the art of scuttlebutt.
So how exactly do you measure those qualitative factors? Well, you use a method Fisher coined called scuttlebutt. I know, it's a funny-sounding word, but it's an incredibly powerful concept. It literally means bypassing all the rumors, the noise, the sheer malarkey of Wall Street, and going straight to Main Street. If you want the real, unfiltered truth about a company, you don't just sit there reading their annual report. I mean, obviously, they're going to make everything look completely rosy in there. No, you go out and you talk to their competitors, their suppliers, their customers. You get that real-world, first-hand intel.
Warren Buffett actually highlighted exactly why this works so well. The quote right here really hits the nail on the head. Go out and talk to the competitors, suppliers, and customers to find out how things really operate. Think about it. A competitor has literally zero incentive to lie about how good the other guy is, right? If you chat with a rival sales rep and they admit they're losing sleep over this target company's new product, or if a supplier tells you, yeah, this company is our most demanding but reliable partner, that is absolute gold. That tells you what a spreadsheet just never could.
All right, moving on to Section 3, the 15-point stock playbook.
So now that we know how to do the research, what exactly are we looking for? Well, Fisher laid out this highly prescriptive, incredibly detailed checklist in his 1958 classic book, Common Stocks and Uncommon Profits. And I gotta tell you, the principles in this book are just as vital right now as they were way back in the post-World War II bull market. Fisher totally ignores short-term profit chasing. His entire focus is on finding sustainable, long-term compounding growth.
Now, Fisher's original list has 15 points, but we went ahead and distilled the absolutely crucial ones for you right here. First up, the company has to have products with massive growing sales potential for years down the line. Second, effective R&D and a real dedication to innovation. Like, are they already working on the next big thing before their current hit peaks? Third, they need an above-average sales organization because, let's face it, even the greatest product ever invented won't sell itself. Fourth, worthwhile profit margins that they fiercely protect. And fifth, outstanding executive and labor relations. Look, a company that treats its people well keeps its top talent, and that directly shapes its long-term financial destiny.
Later on, Fisher kind of condensed these down into what he called the 4 dimensions of a conservative investment. Number 1, superiority in production, marketing, and research. Number 2, outstanding people. Number 3, protection of profits. And only then, number 4, a low price. You see, Fisher always preferred a high-quality business over a cheap one. Price definitely matters, sure, but those first 3 dimensions, that's what ensures a company actually survives and thrives no matter what the broader economy throws at it.
Which brings us perfectly to Section 4, offense is the best defense.
When most of us hear the phrase conservative investing, we picture, boring, stagnant companies. But Fisher argued the complete opposite. Let's look at 3 hypothetical companies to see why. Company A has 0 growth. It starts with a PE of 10. 5 years later, still no growth, the PE is still 10. Your return? 0%. Now look at Company B. It's a strong growth company. Because it's growing, you got to pay a higher PE of 20 to buy in. But in 5 years, it doubles its earnings. The market still loves it, so the PE stays at 20. Boom, your return is 100%. Then there's Company C, the cautionary tale. Starts as a growth company with a PE of 20, and it does actually double its earnings over 5 years. But let's say they have some terrible management issues along the way. The market gets spooked, loses faith, the PE contracts all the way down to 10. So even though earnings doubled, the valuation got sliced in half, leaving you with, a 0% return. Fisher's rule here is simple, really. The further into the future profits will continue to grow, the higher the PE ratio you can safely afford to pay today.
All right, let's pivot to Section 5, red flags in management. Sometimes finding great management is actually way easier if you know how to quickly spot and run away from the weak ones. Fisher had this amazing metaphor. He said high profitability is like an open jar of honey in the middle of summer. And what happens? It attracts flies. In the business world, those flies are competitors. If a company is incredibly profitable, rivals are going to swarm in to try and steal that market share. A great management team builds protective moats, economies of scale, killer brand loyalty, complex tech to protect their honey. Weak management? They just let the flies take over.
So what exactly does that weak management look like? Here are 6 glaring red flags you can spot pretty easily. 1. A CEO hired from the outside. Look, if an outsider can just stroll in and learn the business in a few months, it means the business isn't complex enough to have a real moat. 2. An excessive CEO salary compared to the rest of the team. 3. Constant media complaints or, frankly, terrible Glassdoor reviews because unhappy employees kill innovation every single time. 4. Unfulfilled promises in past shareholder letters. 5. A board of directors where the CEO is the only executive, meaning there's literally no one there to challenge them. And 6. Engaging in totally unrelated activities. Like Fisher said, a jack of all trades is a master of none. If you see these signs, run. That company is not protecting its jar of honey.
And finally, Section 6, the power of patience.
This might be the most crucial lesson if you actually want to see those uncommon profits. 14. That's the number. Over several decades, Philip Fisher built a massive fortune by holding a core portfolio of just 14 stocks. Not 14 stocks a month, 14 stocks over spans of up to 30 years. Once he used his playbook and that scuttlebutt method to find a genuinely world-class company, he bought it and he held on for dear life.
Wall Street is completely obsessed with short-term trading. You always hear people say, well, nobody ever went broke taking a profit. Fisher absolutely hated that phrase. He called it a completely unrealistic argument. Why? Because that buy low, sell high, constant trading mentality is basically a small win proposition. It totally ignores the reality of investing, which is you are going to make mistakes. You will have losses. To offset those losses and actually build serious, life-changing wealth, you need massive multi-bagger gains. You're never going to get a stock that goes up 1,000% if you sell it the very second it goes up 20% just to get your bait back. If you found a phenomenal company, just hold it.
Which leaves us with a pretty important final question for you. Do you actually have the patience to ignore all the daily market noise and just sleep well? Philip Fisher proved beyond a shadow of a doubt that true, uncommon profits come to those who do the hard research, who look way beyond the raw numbers to the actual people and products, and who have the ultimate discipline to hold on to greatness once they finally find it. So, can you stick to this playbook? The rewards, as history has shown us, are absolutely incredible. Thanks so much for joining me on this explainer, and keep learning.